So again, I'm Valerie Shoudy. I work with the U.S. Small Business Administration. I know most folks, but not everybody. So I represent a federal agency. The SBA is a federal agency, and my role is working with our lending partners for the most part. And as a lender relations specialist, I do have a coworker, Grace Connors, who works with me, and together we work with our lending partners in 34 counties. Cayuga is as far northwest as we go, everything above the Thruway down to Columbia County and over through into Steuben. So it's the two of us, and our contact information will be at the end of the presentation, plus I have cards that work with you, our lending partners. We do have offices. Our office is in Syracuse. Our main office, we have, I think, 6 people there with a director and the attorney, 1 person in Elmira and 1 in Albany. Those folks are more on the economic development side, working directly with small businesses and our resource partners. But today we're going to focus just on the SBA's loan programs. And it'll be a high-level overview of the programs, just to refresh or to introduce for some of the folks in the room today. So this is our public website, sba.gov. And if a small business was to go here, it would tell them that SBA helps them get small business loans. In reality, we're working with our lending partners. We're helping our lending partners to provide their loans or your loans to the small businesses. And that is because we, as a federal agency, do not lend directly to small businesses for business loans. We do have a disaster loan program, but that's a whole nother side of the house. So what is our role as a federal agency is to offset risk, to help those projects that are not the golden deals with our lenders that are very competitive amongst yourselves. We are here to help those projects that are viable and need a little extra reduction of risk, and that is through the SBA's programs. So I'm going to highlight the 3 programs that we have this morning. The smallest one is called a microloan program, and this is where we provide to one of our approved intermediaries a loan that they repay to the SBA. They take those funds and match them and turn it into their own lending program, the SBA's microloan program. It allows them to provide funding up to $50,000 for business uses with the exception of real estate use of proceeds. So it can be working capital, equipment, leasehold improvements, things of that nature. The program works through the intermediaries. They are our SBA lender. They are the microloan lender. For this market in Cayuga County, we have one of the representatives here, Ben, raise your hand, thank you, who works with the 504 company. I guess that's our lender of record for that program. He has many hats, but that's the program. And so the small business goes directly to them, and oftentimes, like the programs here, it works in combination with other funding that's coming to the table. They're helping a bigger part of a project. Other lenders are at the table. Maturity is up to 6 years. The microlender sets the interest rate, and the process is entirely through our microlending partners. They have a board and they have their own lending policies. That's it. Really quick overview of that program. And I have resource guides out on the table out there. It's a glossy magazine that we have, and contact information is on page 29 if you don't have the opportunity to meet Ben before you leave today. All right, next. Our second program is called the 504 Loan Program, and its focus is on long-term fixed asset financing, below market, and it's for viable businesses that are in a growth mode or an expansion mode and can include startups and change of ownerships. It needs to be for owner-occupied property. They can acquire it, they can build it, they can renovate it, they can put on an addition, and also machinery and equipment that has a useful life of at least 10 years. So this 504 loan program is specific, again, to funding fixed asset projects. In some cases, there's qualified debt that could be a part of the project. There's three primary parties, although there can be more, but the traditional way for this program to come together is three primary parties. The SBA, our 504 loan, is in a second lien position for no more than 40% of the project costs. We'll talk about project costs in a moment. We have a conventional lender, which is most of you here, who are in the first lien position and only up to 50% of the costs. And then we have our borrower, who has to make an equity contribution. One of the benefits of this program is it can be as low as a required minimum 10% of the total project costs, which can be cash. Sometimes it can be equity in the project, land and buildings that are part of the project if they already own it. It's possible to do that too. Their participation, the small business, may have to increase by 5 or 10%, so in other words, be 15 or 20, if they are a new business. And SBA's definition of new business is they've been in business 2 years or less, or it's a special use type property. Hotels, motels, marinas, golf courses, gas stations. So they could have 10, 15, or 20%, but still at 20%, that's pretty low equity injection. So a little more detail. They must be a small business, and this is our definition of a small business. And we're looking for, in the 504 program, for them to create and/or retain jobs. This benchmark was just expanded more favorably at the end of last year. So for the SBA's 504 loan, that second lien position, we're looking for one job to be created and/or retained for every $75,000 of our loan. $120,000 if it's a small manufacturer. There's a little more flexibility. But what if the project just can't get there? Okay, we can't get those jobs created or retained. There are other ways to meet the jobs requirement, and it can be offset by specific community and public policy goals that the agency has. Here are some of them. One of the newest ones that just developed this fall is if the project itself is located in an opportunity zone. We're aiding in rural development. SBA qualifies Cayuga County as rural. We're expanding exports, or the business itself is owned and controlled by women-owned, minority-owned, veteran-owned businesses, and there are several other objectives that we can look at to offset that jobs requirement. Okay? And this is at time of application, and it's being proved out through their projections. Let's briefly talk about each of the parties. We have the third-party lender, which is traditionally conventional lenders. We have the SBA, and we have the borrower. Other lending sources can very much, though, be a part of the funding sources. That is very viable. Typically, the third-party lender is a financial institution. They're in the first lien position for up to 50% of the costs. We're helping that lender to reduce risks, and they have to show why they need the 504 project. So that third-party lender is going to say, well, it's perhaps an existing client, and we only can go so far with our lending limits with them. We're at our limits. Or it's the type of business. It's a higher risk industry that we typically don't lend to. Maybe they're time in business, or it's a change of ownership. Typically, we're not looking at those projects. For credit reasons, that third-party lender has to demonstrate, why they need the 504 project. Why would they not do it on their own? That's typically not difficult to do. That third-party lender, it's your loan, you're underwriting it in-house, you're making all your credit decisions in-house, you're setting your interest rates. It has to be a minimum 10-year loan. It could have a balloon. For SBA loans that are up to 20 or 25 years, those are typically our real estate based projects. 7-year minimum for a 10-year SBA loan. But do note that the lender's first position has no backing from the SBA. But why do you need it? You're in first lien position for 50% of the costs. Nice position to be in. Okay. Next, we have SBA. That's the second party in these projects. We are, again, in a second lien position for up to 40%, and we have it's not SBA working directly with the borrower or the small business or the lender. It's our CDC, what we call the Certified Development Companies. We have approved and long-established CDCs. We actually, in our 34 counties, have 3 that are headquartered in our district. 2 primarily service Cayuga County, and that is what we call Greater Syracuse Business Development Corporation, GSBDC. And if you don't know the folks that are at their organization, they're here today, Peggy Adams and Kathy Campbell. And we also separately have Ben Alexander here from the 504 company. They're both based in, both organizations are in Syracuse. They both service this county, Cayuga County. Our CDC, the SBA CDC, works with the lender, your third-party lender, the borrower, and basically looking at the project, helping to structure it, making sure it meets the SBA's guidelines. They are underwriting the SBA part of the loan, that second lien position, and they are the ones submitting the whole project to SBA and working with our center in California and having the project approved. Okay, but along the way, they're coordinating again between all the parties to get all the documentation together, get all the project finalized to submit it to SBA for SBA's approval, and the approvals are done out in California. Our participation is a second lien position up to $5 million, but it can be increased to $5.5 million. Small manufacturer and certain energy projects. Energy-based. I'm not going to go into those details right now. The SBA loan is 20 or 25 years now for real estate-based projects. If it's strictly long-term equipment, it's a 10-year note. You can have one project that has both equipment and real estate in it also. There can be a combination. Typically, the closing costs like attorney's fees, appraisals, environmentals, they're all rolled into the costs together with the SBA fees, and that makes up the total project. All right, doing good. The last party is the small business, and as we chatted about, they will put in 10 to 20% equity into the total project costs. This lower equity participation is very critical to this program. It's letting them keep their working capital in-house because they're in a growth or expansion mode and they need those funds to fund the operations that are making this project, as a result of this project. Okay, so that's the important part for the small business. They're getting affordable and a fixed rate financing from SBA. Our note rate on the second lien position is in place for the life of the loan. In January, the rates were between 4.65 and 5 for 20-year terms, and a little lower or a little higher for the 25-year loans. Fixed for the life of the loan. So let's give a quick example, which I didn't type out, but let's say again you have a business who's not new. They've been around for several years. They're in a leased location. They like this location. Now they have the opportunity to buy it. And in doing so, at the same time, it needs some upgrades. Maybe it needs a new roof, some infrastructure. They want to put some renovations into it. So they're buying a building, they're putting in some renovations, and they are not special purpose. So we have a project where the small business is at a 5 or 10% equity contribution. They're not new, they're not special purpose. So the building is $500,000, renovations are $80,000. Closing costs are $50,000, so we have a total project of $630,000. This would be the traditional 50-40-10, where our third-party lender is going to put in 50% of the project costs that I just stated were $630,000. So we're in the first lien position for $315,000. Not a bad position for the first lien or the third-party lender. The SBA is in second lien for $252,000, which is 40% of the costs. And the small business equity contribution is $63,000 for a project of $630,000. So that's this program. How do you get it started? The lender or the small business reaches out to our lending partners in this program, our CDCs, GSBDC and the 504 company. And they're going to sit down with you and talk it out about viability, eligibility, potential costs, and move forward with you and work very closely with you throughout that whole process. Okay, the third program, which I think, yes, all the lending partners, our banks and credit unions that are in the room, you are all part of our 7A guaranteed loan program. You are an approved SBA lender for this program. And they are business loans that are issued by you, our lenders, our lending partners, for the loans that you want to provide to your small business customer. That's the bottom line. The SBA's role is we're going to provide a backing to you, the lender, on that loan. The benefit to the small business is, and you'll see in the next two slides, that without the backing of the SBA, our lender is not able to provide this loan on what we call reasonable terms, or not at all. When I talk to the small business community, we're explaining to them that it is the lender's loan. You're going directly to the lender and you're applying to them for their loan. You are going through the lender's own process. The lender is going to look at its, I explain it to the small businesses, saying their own business plan for you, your lending policies, to see how it fits into that and what decision they need to make based on your application. And you as the lenders you're going to either approve it on your own, it meets all of your policy, you're going to decline it because it does not and is not a viable project, or you're going to think SBA, you're going to say, you know what, I really want to work with this customer, I like their project, I think it's viable, there are some shortfalls or weaknesses, but with the SBA's guarantee, we can make this project work. So if the small business went to our website, this is what they see. They're applying to the lender, you're reviewing it, you're making the credit decision on what route to take. Hopefully you're providing, if you cannot do it on your own, the SBA's guarantee is viable. You are approving the loan, getting the SBA backing, you're dispersing the loan to the small business, and they're working with you along the way. We're in the background. Our role with the lender is that we are basically a contingent guarantor. We're guaranteeing a percentage of the total loan you're providing. And should down the road the business fail, it closes, the loan cannot be repaid in full, your teams are going to liquidate whatever viable collateral there is and get that loan balance down as far as they can. And likely there's still going to be a loan balance. There's going to be a team at your institution, so they're going to prepare a request to send to SBA and say, honor that guarantee. Guaranteed 50% of our loan, the balance is down to $100,000. Please honor that guarantee, and SBA is going to review it. And if we, when we approve it, we're going to pay our lender $50,000. We guaranteed 50% of 100. You're going to get back $50,000. So your loss was cut down to 50 instead of 100. And that's the role that we play with our lending community. Again, the benefit to the small business was that up front, you could not approve the loan on your own. So it might not be easy to see, but at the top of the triangle are the loans that meet your business plan, meet your loan policies, you're going to approve it. On the bottom are projects which are not viable at this time. And you're going to have to send the customer away. In the middle, we're going to expand your universe of approvals for credit reasons. You are looking at it, and the type of business, the industry is, traditionally a higher risk industry. You want to offset that. New or untested management, it's a change of ownership, new folks are coming in, you really don't know them that well, you want to offset the risk, or it's a startup. There's a collateral shortfall. Probably 99% of the SBA guaranteed loans have a collateral shortfall. There were prior credit history imperfections, and maybe they were only occurred 5 years ago, and your policy is to wait 7 years. Their credit right now is good. They have no outstanding liens or judgments. They had no federally discharged debt, and you want to work with them because you like the overall plan. If you do the pluses and minuses, they're showing repayment ability. Always have to show repayment ability, whether historically or projected. Hopefully they have a good management team in place to make those numbers work. But the minuses are, collateral shortfall. Could be that you traditionally want 20% into the project, they can come in with 15. So you offset that credit weakness, a little higher debt service by getting the SBA backing. It could be that for the type project they're looking for, their plan shows they need 7 years to repay it. You typically only go 5 on that type of use of proceeds. You can use the SBA to get them a longer loan maturity. The idea is that you're getting them a loan on reasonable terms you cannot otherwise offer on your own. What I didn't put in here is that most of the lenders in the room, the SBA part of the process is internal. You are delegated lenders. You have the authority to approve SBA loans and get our backing without the SBA seeing those projects. There are teams that put this into an electronic system and they push a button and they have an SBA approval and an SBA loan number back. So almost 80% of our loan approvals, and we had almost 600 loans approved last year, our lenders were making the decisions without SBA internally. You have that authority. The other 20% that are going to our centers, the system is pretty streamlined right now, and those, when SBA is involved, those projects are being turned around, if they're complete and simplistic, within 24 to 48 hours. If they're more complex, up to 10 business days. Not so bad. Okay. Use of proceeds, the traditional use of proceeds that you would have for business loans, short-term through long-term assets. You can use the 7A program for, real estate also, refinance of debt. And if you're an express lender, you can have a revolving line of credit for up to $350,000, revolving up to 5 years. Terms, they're your loans. So overall, you're structuring the repayment, the terms of the 7A loan within our parameters. Up to $5 million, as small as $1,000 if you wanted. 25 years, you can go up to 25 years on real estate, 10 years on short-term assets. Useful life of the equipment. We do require personal guarantees for both programs. And the only requirement we have on equity is that if it's a startup, minimum 10% equity, change of ownership, minimum 10% equity, which is pretty low, pretty low. So, to wrap it up, if you need help, Grace and I are here to walk you through and talk about, just like they are here at CEDA, to talk to you about projects. Even though you internally have a team that's going to do the SBA process, you still want to talk about, you think it's eligible, what do I need to think about, how can I structure it? We're always here. We're here for training, we're here for systems help. Our district counsel is very much available to answer legal questions, and this is our contact information. Okay, thank you.